Hello, folks. Welcome to this video. We're going to talk about US equities, an ignored gold mine or a trap. A lot of analysis has gone into this study, so please stay till the end of the video. Let's meet Ravi, who is a savvy investor, has benefited from India's growth story since long. And one day he reads that many Indians are investing in the US stocks and he wants to invest as well. And he thinks that, am I missing something? So he immediately opens Nifty 50 chart and compares it with S&P 500. So this is what he sees in the last 35 years. Uh, S&P 500 is here, the yellow line, and the light blue line is Nifty. So he feels that I did well by investing in Nifty because Nifty has done far better than S&P 500. But he's overlooking a very key factor, and that is the currency effect. In absolute terms, he's comparing apples and oranges. So we need to adjust Nifty from INR to USD terms and then compare it with S&P 500 to see the real impact. And when we do that, you find that this white line that was there for Nifty, the story has completely changed. And in dollar terms, when we see Nifty, it is this blue line which is hugging the S&P 500 line. So over almost 35 years, by the end of 35 years, there is hardly any difference between the two. Of course, S&P slightly outperforming Nifty 50 over this period. So the market, which Ravi and many others thought was a clear winner, is now lagging behind, and the one he dismissed is showing superior returns. So what is actually going on here? Let's dive in. So let's understand the key factors for Indian investors to understand about US equities. First factor is that of diversification. Now, let's take an example of last 25 years and see 10-year rolling returns in three phases: phase 1, 2, and 3, 2000 to 2005, 6 to 14, and 15 to 25. In the first phase of 2000 to 2006, you can see that the red line is that of the 10-year rolling return on S&P, and the blue line is that of 10-year rolling return on Nifty. You would find that S&P 500 portfolio would have done better during phase 1, while Nifty had its challenges in 2002 to 3, and of course in 4 as well. Uh, S&P 500 was doing well in that period. In phase 2, S&P 500 started to decline, and for the next almost, you can say, till 2014, Indian markets did well. They recovered much more strongly after the GFC, the crisis that you see here, and S&P actually turned negative during that period. So you can see that 10-year rolling returns were negative for a significant amount of period uh, in S&P 500 from 2009 till 2011. Phase 3 was post 2014, where S&P actually rose very well. The 10-year rolling returns from 5% going on till 12%. And while Nifty was at 13% then, it has not regained 13% so far till then, uh, closing at around 9% on a 10-year basis. So in this phase, both have done reasonably all right, but S&P 500 is marginally outperformed. So when we see the entire picture, what we see is that US equities have shown low and negative correlation to Indian equities over long duration. So this is the key actually for diversification, that when the Indian market is doing well, the US market is not doing well. When the US market is doing well, Indian market is not doing well, and so on and so forth. So there is very low correlation between the two. And you can see here in 5-year rolling returns and 10-year rolling returns, the correlation is actually negative, and it's low. The second factor is that of risk. So now when we see the drawdowns in S&P 500 versus Nifty 50, you can see in the last 35 years, we've had some massive drawdowns in Nifty: 54%, 54%, 55%, 65%. Again here, uh, approximately 45% right here. Then we have another 35% right here. So huge kind of drops in Nifty, while S&P had two major downtrends at 46% here and 52% here, and somewhat here at minus 24%. And you can also see that there is a phase or lag shift between drawdowns most of the time, except perhaps in 2002 and 3, both were down here, and in 2008, both were down here. Otherwise, there were many instances where Nifty was down, but S&P 500 was hugging the new high. Even now, right now, in Feb Nifty was down 18%, but S&P was down perhaps 1% or so. So there were multiple periods where there was uh, good compatibility of having both together in the portfolio, and hence the diversification effect. On a CAGR basis, last 35 years, CAGR has been pretty much same, 12.5% there, Nifty uh, at 12%. And when we compare it on a uh, risk adjusted manner, when we look at the risk to max drawdown, that returns to max drawdown, I'm sorry, then you see S&P 500 has clocked better at 23.7 versus 18.3, and even Nasdaq is at 24.3. The third factor is that of currency. USD has appreciated by about 4% CAGR against INR from the last 35 years. And what does that mean for the Indian investors? It means that significant outperform by Indian investors over US investors uh, in rupee terms. So when we look at rupee terms, of course, Indian rupee returns look great. But even when we sort of see in dollar terms, like this chart is in dollar terms, and this is S&P 500 versus uh, uh, the S&P in rupee terms, then we find that the returns for Indian investors investing in S&P 500 is also superb. Uh, this chart is from 2007 till currently. So what we are seeing is that significant outperformance has been there by Indian investors over its US investors investing in S&P 500. When we look at the factors which is that of US companies. Now, US companies are global leaders. They're truly global in nature. 42% of their revenues are generated outside the US. So there is, of course, no comparison between what scale and size of companies that they are having. Like Nvidia is $4 trillion now. It's almost equivalent to the entire Indian market if you compare the market cap of that company. And there are huge number of big conglomerates and mega companies there, some of which are there on the screen. And the scale and concentration of innovation that is there in those companies is unmatched anywhere in the world. So that also sort of pulls you towards investing in those companies to be with the leading and innovation change that is happening in the world. So until now, it all looks attractive, but just like anywhere else, there are certain factors that investors need to be wary of. And the most important factor is INR appreciation. What happens if INR appreciates? That is the biggest risk. There's a lot of talk about US dollar collapsing in the next few decades, and India regaining some of its past glory. Whether it will or not, nobody really knows. But a major portion of alpha generated for Indian investors in US market is because INR is depreciating at 4%. So there is no certainty that it will keep happening in the future. So for example, if we look at the period of 2009 to 2011, INR appreciated by US dollar by 15% during that period. And there are many such instances where in short term duration, USD has depreciated against the US dollar, against the INR. So that would basically harm your returns in those periods. The complexity of the taxation on US stocks also is somewhat not so easy. Um, all US short term capital gains are basically taxed at your slab rate. So there is no 20% business that happens when you invest in US stocks. Basically, any short-term capital gain that you have to pay slab rate on that. And uh, there is some friction in terms of sending your money. So there is a transaction cost of sending money to your US broker. There is some cost of getting your money back when the broker will remit to you, and there is some limits beyond which you can't go, the LRS limits in a year. So all these are small frictions that are there, and these are not really the reason why you should not be investing in my sense. uh, because Indian market has significant cost of transaction. There the cost of transaction is very low. So some of these costs actually get covered up because of the cost of transaction is very low. And of course, if you make fantastic gains, let's say even beyond S&P 500, then all these costs will become insignificantly low. The third risk, of course, of investing in the US market is that you may miss out from your home gains. So maybe in the next 20 years, India may do much better than the US market. That is always a possibility. We are the fastest growing major economy, and there may come a decade where we get a complete euphoria of exponential curve going up. So with more and more opportunities in India, and combined with a deeper understanding of domestic markets, perhaps investing in the Indian market itself is good enough. But again, it's very difficult to argue for this way or that way. And a lot of investors don't want to go to that extra step, although some part of your portfolio you can certainly diversify. And there are good strategies that are out there where you can invest just like you invest in the Indian market. You can invest in the US markets as well. So the bottom line is that some small portion in Nasdaq 100 or S&P can be considered given your portfolio construction and needs. Investing only in India targets high domestic growth but ties your entire portfolio to a single economy and to a single currency. The currency risk remains the biggest risk. So what happens if our currency goes for a toss for whatever reason? Maybe we get a government which is not supportive of the policies that we currently have. Uh, Adding US stocks, of course, can diversify your portfolio across global markets, but they also introduce currency effects and they add taxation complexity. And the right strategy basically will depend on your personal goals, prioritizing concentrated growth or seeking global diversification. Some people have a very strong view about certain companies, certain US companies, and that may actually generate a lot of alpha for your portfolio. But again, I mean, it will depend on each individual how they see the market, or whether they are following a momentum strategy, for instance, in the US market, which also works very well. So tell us in the comments, are you planning to invest in the US markets or not? And if you have already invested, what has been your experience? And if you like this video, perhaps you may like this other video that you can see on your screen. And certainly give us feedback on our videos, our content, this channel. And if you like it, do like and share it, and do subscribe to it. Thanks. Bye.